Legendary investor Michael Burry has come out on Twitter and in the news saying that we are in a bubble. He has said that recent surges in shares have reminded him of the dot-com bubble. He says that he's compared it to options trading, booms and crashes, and overall historic market crashes. Michael Burry is thinking that we are about to experience, in his words, the mother of all crashes. So in today's episode, we're going to discuss, are we going to see the mother of all crashes? And if so, how should we go about navigating it? Hello and welcome to Global Markets. And in today's episode, we are going to be discussing Michael Burry's claims that we are in a share market bubble. Each week, we talk about trading, investing, and economics. Please like and subscribe. So, in 2019, we experienced the coronavirus pandemic. It killed many people and has sent markets tumbling. The US stock market crashed. The Australian stock market crashed. Markets across the world looked like they were about to reach all-time lows, and they were potentially going to collapse at an unprecedented rate. Analysts were saying it's going to take us 5+ years to even start to recover from coronavirus. However, we fast forward 2 years later, we are reaching all-time highs across all asset classes. We have seen the S&P 500 as trading at all-time highs of over $4,000. We have seen that the S&P 500 news headlines have gone from, are we going to reach all-time lows, to how high are we going to go in our historic rallies? We have Dogecoin and cryptocurrencies have also experienced a boom this year, rising thousands of percent. So the question remains, are we in a bubble, and will we see a correction to that bubble? So firstly, what do we consider a bubble? There are two main market terms that we need to understand to consider whether we are in a bubble. The first is market value, and the second is intrinsic value. Market value is simply how much a share is priced on the share market, whereas intrinsic value is an objective measurement of how much the share is worth based on future growth and the company's earnings. The market value, however, can also be stimulated by social trading and meme trading, as seen with the recent GameStop and Tesla booms. So we develop a bubble in the market where our market value grows at an unprecedented rate, whilst our intrinsic value remains constant. And as we have seen throughout history, a market value will eventually meet intrinsic value. However, before we go saying we're in a bubble, we have to remember that intrinsic value can also grow. So one of the ways that we can measure the premium that investors will have to pay to get a share is the PE ratio. So to further explore this term, it's simply calculated by taking the earning per share divided by the share price. So let's look at some examples. For example, Apple has a PE of 29.52. This means that for every dollar that Apple earns, investors will have to pay 29 times that to get it at the market value. Generally, a PE does not have to be 1. This is because we have market growth and future growth that goes into the value that it should be worth fairly. For example, if Apple had a PE of 1, this means that we're assuming that its earnings are going to be constant and that there's no room for it to grow. However, we value it higher because we acknowledge in 10 years' time, we predict it to be earning more money and for its intrinsic value to go up. So the PE ratio is simply the premium that we are paying. However, this premium can be a matter of concern when it reaches to unprecedented levels. So an example is Tesla. Tesla has a PE of 404. That means for every dollar that Tesla earns, investors would have to pay 400 times that to receive the shares. So this has led to people being very speculative over whether Tesla is overvalued. And fairly so, because a PE of 404 is extremely high. It means that you are thinking that the growth in years is going to be enormous. And we have seen a phenomenon with GameStop, where social media and social trading has meant that its share price does not correlate to its earnings at all, going at 300. And GameStop is also a share that is not very likely to be growing at the rates of companies such as Tesla. However, another phenomenon that we have seen is Afterpay on the ASX. Afterpay does not have a PE ratio. This is because Afterpay isn't earning any money yet. And we've seen this phenomenon with lots of startups where they aren't earning any money and their share price is going up. And this is because investors are paying purely for the growth of the stock and the growth that they'll see in the future. This concept has divided the investment community, with some people believing that it's a sign of a bubble when we're paying for something that's valueless, with other investors saying that it's a sign of a new market era where we value growth and we look for companies that will grow rather than companies that will necessarily only stay at a consistent growth. We have seen this investment has been changing over time. We see more traditional investors such as Warren Buffett looking for the really solid shares, whereas we have seen more modern investors such as Cathie Wood looking for extreme growth. So let's look at the S&P 500 average PE. So if we pull up the graph, we have seen that it's generally been above a level at 30. Every time it has gone above 30, it has been unable to sustain a market value and it has crashed. So, for example, when we look at previous examples of where it has been above 30, we look at the dot-com crash, we look at the GFC, and now we're in this uncertain time. In statistics and mathematics, there is a concept of divergence to the mean. This basically means that the PE ratio should be traveling around the mean. And when it goes up, it'll correct to the mean. When it goes down, it will go up to the mean. And this can happen in two ways. Either market value decreases, or the intrinsic value increases. So this obviously sends alarm bells in many investors' eyes. However, Cathie Wood, who has been leading one of the top performing funds, says that we are not in a bubble. Instead, she says that increased market values are a sign of increased intrinsic value. And she credits this to artificial intelligence, machine learning, and economic progress. She says that the intrinsic value will be meeting the market value by going up rather than the market value going down. So we have seen there have been two schools of thought. We have Michael Burry, Warren Buffett, Charlie Munger, and we have seen Cathie Wood, who has been saying that we aren't in a bubble. This isn't something that we can necessarily be for sure whether we're in a bubble or not. So what is the verdict? What do we think is going to happen? The honest truth is we have two values. We have our market value and we have our intrinsic value. And they will meet each other if history is to be trusted. However, how they get there, it depends. We can either have an intrinsic value grow to meet the market value, or we can see the market value, as Michael Burry says, shrink, and we can see it's the mother of all crashes. However, there are a few things that we should be careful of when investing in this current market. Firstly, we should make sure that we do our research. Make sure that we have a diversified portfolio if we are investing in shares such as Tesla, which we are expecting growth. We should also employ some hedging strategies and stop losses to make sure that we won't be victim to a market crash. This is a market that we can still trade in. The current market situation and the question of whether we are in a bubble does not necessarily stop us from trading. However, it does mean that we need to be careful We need to have great risk management in place, and we need to be researching the company. This is very important. We're living in a time where everyone is IPOing. We are seeing so many IPOs happening that it is crucial that you look at a company and you look at their management, their values, their finances before you choose to invest. And if you're unsure on what to do, you can always look at ETFs and index funds, which over time, through dollar cost averaging, has gone up. So that is it for our episode of Global Markets Today, where we discuss the latest trading, investing, and economics news.